What's the real difference between a bull and a bear market? And why do these terms seem to dominate every financial conversation? If you've ever tuned into a financial news channel or scrolled through a market forum, you've likely come across these two terms being thrown around, often with a sense of urgency or excitement. But have you ever stopped to think about what they actually mean and how they impact the market as a whole? The idea of a bull market, where everything seems to be going up, and a bear market, where everything seems to be going down, can be misleading. It's not just about the direction of the market, but about the underlying mechanisms that drive these trends. Think of it like the tides. A bull market is like the tide coming in, lifting all boats, while a bear market is like the tide going out, leaving some boats stranded. But what causes these tides to change? And how can understanding the difference between a bull and a bear market help you navigate the complex world of finance? Let's break down the mechanisms that drive these market trends and explore the real difference between a bull and a bear market. What's the real difference between a bull market and a bear market? And where do these terms even come from? Many of us have heard that a bull market is when everything is going up and everyone's feeling optimistic, while a bear market is when prices are falling and investors are pessimistic. But here's the surprising part. These terms actually originated from the way each animal attacks. A bull, when it attacks, thrusts its horns upwards, symbolizing a market where prices are thrusting upwards, driven by optimism and investment. On the other hand, a bear swipes downwards with its paws, representing a market where prices are being pushed down, often due to pessimism and selling. This isn't just a quirky etymology, it hints at the underlying market dynamics. In a bull market, investors are actively pushing prices up, much like the bull's upward thrust, whereas in a bear market, the downward pressure is driven by investors selling and prices falling, akin to the bear's downward swipe. Understanding the origins and mechanisms behind these terms can help clarify the mindset and strategies of investors during each type of market. By grasping this fundamental difference, we can better navigate the complexities of the market. To dive deeper into how these markets work and what they mean for your understanding of the economy, consider subscribing for more explanations that break down the world of finance into clear, actionable insights. Vocabulary, volatility, optimism, etymology, dynamics. What drives the difference between a bull and a bear market? And how do investors really make their decisions? The answer lies in market sentiment, which is essentially the overall attitude of investors toward the market. Think of it like a big room where everyone's talking about the economy, and the noise level is either excitement and optimism or worry and pessimism. This sentiment is driven by investor attitudes towards risk and potential returns. Are they feeling bold and eager to invest, or cautious and hesitant? And here's the surprising part. Sentiment can shift rapidly in response to economic indicators, like GDP growth or unemployment rates, policy changes, such as interest rate decisions, and global events, like political elections or natural disasters. It's like a big, collective mood ring that changes color quickly, influencing how much risk investors are willing to take on. Understanding the sentiment is key to grasping why markets move from bull to bear and back again, because it's not just about the numbers, it's about how people feel about those numbers. So, to really get a handle on bull and bear markets, we need to dive deeper into what shapes this market sentiment, and that's exactly what we'll do next. Vocabulary, sentiment, indicators, volatility, momentum. What happens when market sentiment shifts from optimistic to pessimistic, or vice versa? And how does this affect the price of assets? To understand this, let's dive into the mechanisms of market movement. Imagine a marketplace where buyers and sellers meet to exchange goods, in this case, financial assets. The marketplace is essentially an order book, where buyers place bids to purchase assets at a certain price, and sellers place offers to sell at a certain price. Now, when market sentiment is bullish, more buyers are eager to purchase assets, hoping to profit from rising prices. This increased demand outstrips the available supply, causing buyers to compete with each other to purchase assets at the best possible price. As a result, prices are pushed upwards. On the other hand, in a bear market, sellers dominate the landscape, and the supply of assets exceeds the demand. With more sellers than buyers, the pressure is on sellers to lower their prices to attract buyers, driving prices downwards. And here's the surprising part. This self-reinforcing cycle can create a snowball effect, where rising prices in a bull market attract even more buyers and falling prices in a bear market attract even more sellers. By understanding how market sentiment influences the order book and ultimately the price of assets, we can better navigate the complexities of the market. So, let's keep exploring to see how this plays out in real-world scenarios. Subscribe for more explanations on how markets work. Vocabulary, sentiment, order, supply, demand. What if everything you've heard about bull and bear markets being solely driven by economic fundamentals is only half the story? Many of us have been led to believe that the strength of a country's economy, its GDP, and employment rates are the sole determinants of market trends. And while these fundamentals do play a role, the reality is more complex. Investor psychology, for instance, can significantly influence market movements, akin to how a rumor can spread quickly through a crowded room, causing a stir regardless of its truth. And here's the surprising part. Even technical indicators like chart patterns and trends can also impact how investors behave, creating a self-fulfilling prophecy of sorts. Liquidity, or the ease with which you can buy or sell an asset, is another crucial factor that can either fuel or dampen market trends. So, when we consider all these elements together, it becomes clear that each market cycle is unique, shaped by a multitude of factors that interact in intricate ways, making predictions far more challenging than they seem. By understanding these underlying mechanisms, we can better appreciate the nuances of bull and bear markets, and perhaps, just perhaps, gain a clearer insight into the market's inner workings. To dive deeper into the world of market dynamics and uncover more myths, subscribe to our channel for more explanatory content. Vocabulary, fundamentals, liquidity, psychology, indicators. So there you have it. Bulls and bears are much more than just simple terms. They're about something deeper, a complex dance between market sentiment and economic fundamentals. Let's break it down even further. A bull market isn't just about prices going up or everyone being happy. It's really about strong economic growth, low unemployment rates, and positive earnings reports from companies. Think of bulls as the optimistic investors who believe in the future, like a pilot looking at clear skies ahead. A bear market is not just about prices falling or everyone being scared. It's about underlying weaknesses in the economy, high levels of debt, and pessimism among businesses and consumers. Bulls are like those sunny days when everything seems perfect. Bears are more like rainy days when you're expecting a downpour. Understanding these dynamics means recognizing that both bulls and bears serve important purposes. They help balance the market, ensuring that it's not just driven by emotion, but also by sound economic policies and corporate performance. Now that we've peeled back the layers on bull versus bear markets, you might look at financial news differently. You'll be better equipped to see through the hype and understand what's really happening in the market. So remember, bulls aren't always right, and bears aren't necessarily wrong. There's usually a lot more going on. If you'll never look at financial news the same way again, now is the time to subscribe for more in-depth explanations of how markets actually work. Stay tuned.